once again, thank you for joining CoreShares and Michelle and I early in the new year to unpack a global equity allocation and to have a look at some of the different ways of how you can put portfolios together, and really just we want this session to be as interactive as possible. So really just to reconnect with some of our clients and some of our potential clients and investors out there to see what you guys are thinking when you're looking at global allocation. So yeah, please feel free to engage and participate as much as possible. As Michelle introduced me, my name is Chris and I head up our product and client solutions part of our business, which really looks at the kind of investment strategies we're putting together and how we think they may be placed into the market and some of the use cases that they fulfill in advisor portfolios, multi-manager portfolios, or any investor portfolio. So we're talking about global equities, and we wanted to unpack, before we get into any kind of detail around particular strategies, just almost take a step back and look at offshore equities as a general category and look at why one would allocate to an index-based strategy, a systematic rules-based or passive strategy, so many names for it now when one is looking offshore. Now, the thing that you guys probably hear a lot about is the chance of outperforming the index and how low it is. And this feels a bit repetitive, but when one looks at the market share, specifically in our market, the South African market, and when one composes that, it is still dominated by funds that are underperforming indices. As we see, and this is specific to the South African market, the latest SPIVA reports, 91% of active managers actually underperformed a global index allocation. So it's a very low chance of outperforming. It's not to say that you won't outperform, but a very low chance. And really what that means is, with 5 years of track record, there's about 50 global equity funds in our market in the CISA Global General Equity category. What it really means is that of the 50, pretty much 4 funds outperformed what is just the index allocation. And so as a fund selector, as an advisor, where you're trying to make decisions with the highest level of certainty, the highest level of probability, it makes a lot of sense to think about the index, to think about something that has such a high chance of getting you, essentially, if one forgets about active versus passive, into the top decile. Now, the one thing that everyone's been talking about is consistency. So we unpack this over a long period of time, and when we look at this, what we see is that it's not just last year or the year before. Everyone talks about cheap money in the system and all these monetary policies which make market cap weighted indices run very hard in the last year or two, and tech that's been driving it, or in our market everyone's talking about Naspers, etc. If one looks at the consistency of underperformance through time, it is quite staggering to note that like the 91% fund underperformance is actually one of the best kind of 5-year periods that our active managers have had in our market in a long time. Typically, it's only 1 or 2 funds in the whole market that are outperforming the index. So, the point here is when we're making a global allocation, we want to make a global allocation where we know as closely as possible we're getting exposure to global equities. We don't necessarily want to incorporate manager risk where we may get global equities minus 5%. We may outperform global equities, and that's fantastic. But the important thing is here, from a purist perspective, from an allocation of assets perspective, we want to know that what it says on the tin is what is being delivered. And so when we're making a global equity allocation, we're actually getting that particular return profile in our portfolios. So there's this idea that, we think about the world from a lens of asset allocation, and to try and match client portfolios and client needs, we need to get asset allocation right. We also need to ensure that when we allocate to a particular asset class, that we get that exposure. We're not getting some outlier event. So really consistent underperformance, and this is obviously consistent around the world. And really what is a big driver of this is the importance of costs. And on the next slide, I've got an actual cost breakdown of the ASISA peer group that we're talking about. And that would be a large explanatory variable of why this percentage is always so high, why so many managers are underperforming is not because they're not skilled or intelligent or putting portfolios together well. They're just simply charging too much most of the time. And when you charge so much, it becomes difficult after costs to compete with an index. And really this importance of cost it's not something that we preach. This is now an industry-wide kind of concept. It actually first started with William Sharpe. He spoke about the zero-sum game, and these little charts here is a way to try and illustrate it. It really says if you've got a pool of assets, if you've got a market, let's say US equities, and all of that money is being managed in one pot, in totality, that total pool of money will deliver the market return. Okay, so that's on the left. That's saying that all of that money combined equals the market return. You can't get in excess of the market without gearing or derivative structures. So before costs, on average, the average actively managed rand will deliver the market, because on average, it is the market. And the average passively managed rand would also deliver exactly the index or the market. But once we take costs into account, and this is a representative of the CISA averages, we can see that on average, after costs, you are likely to underperform the market in a high cost fund relative to a low cost index-based fund. So that's William Sharpe. He obviously is very well known. The Sharpe ratio is a risk a way of looking at risk in a portfolio. Then John Bogle just spoke quite simply about the cost matters hypothesis, just a simplistic way saying how important costs are. Essentially what your investors receive as net returns, they don't receive gross returns. And so costs are extremely important. But the one that we think is almost the most significant is in recent history, Morningstar, which is famous for their process of actually selecting managers, both active and passive, have released research relative to the global market and the local market, saying that the single largest determinant of a fund success is the costs that it charges. So more so than their famous people process philosophy, the famous P's of Morningstar, it is actually the costs. It's the largest, factor when one looks at a fund that should be considered, along with all that other stuff, of course. But very simply, it is one great indicator of whether a portfolio will succeed or not. And this is the actual experience in South Africa. So it's all well speaking in theory. Here's the actual experience of what costs exist in our market. Now, the ASISA group peer average of 1.18%. This actually includes passive. So this is active and passive. It's the whole bunch put together. So this is not the average active cost. This is the average cost across the whole peer group at 1.2%, which is actually relatively high if we look at it on a global basis. If one looks at the global category, you're looking at more like 80 basis points for a global equity mandate. So the South African market is still quite expensive. And then if we look at the passive only, if I've stripped out passive, on average about 0.55%. Those include smart beta and vanilla index strategies. So those tend to be a bit more expensive. And then if one looks at this, the CoreShares global strategy, it's at, on average, the average of our ETF and our unit trust is 0.36%. So, there's a big gap here between the average cost, including passive, and even, a strategy that we'll talk about a bit later in this presentation. So costs are extremely important. And the reality is that in the South African market, where there was certainly a narrative that South African asset managers simply weren't delivering global strategies, passive strategies at low costs, is simply not true anymore. In fact, the largest global equity strategy in our market is an active strategy that I had a look yesterday. Their TER is over 2%. So one needs to compare 2% actually, if one looks asset weighted to 0.36%. There's a big gap there that means an active manager has to deliver this kind of performance consistently. Now, this is kind of further in the same field, and it's kind of a debunking of myths that, yeah, I would love to allocate money to the index or to passive for my clients, but it just means I'm accepting the average. Now, it's important, if we scroll back, to remember that one would be accepting the average if it were before costs. But after costs, of course, and with the large variance of returns in the market, consistently the index is above average and above average by quite significant margin, certainly more than the 36 odd basis points that we charge to deliver this index in fund format. You can see 6% gap, and over 10 years, a 3% gap between the average return delivered from our CISA global general equity relative to the index. So the index is not average. It's actually consistently above average, and that's something important. So it's absolutely not a cop-out, and it's absolutely something that we should be thinking about how we blend into our portfolios across the board. And so, CoreShares, we actually embrace this concept of core satellite. I mean, it's perhaps very obvious because we're called CoreShares. In fact, in 2015, when we were launching the brand, we said we want to come into the market as someone who is not an antagonist in the market, but rather an asset manager that looks at how their solutions can be combined in portfolios to improve outcomes for clients. So we really embrace this concept of core and satellite portfolio construction. Really, it can go from a super simplistic way of putting together portfolios like this, all the way to far more complex. And I can chat to that, and if you've got questions and so forth, I'd be happy to take them. But really, what are we talking about here? We're talking about an appropriate allocation of risk. And risk is in the context of, well, it's actually in many contexts. It's in the context of manager risk. So by allocating to a passive pool, you're lowering your manager risk. It's in the context of diversification, where by allocating to a well-diversified passive pool, you're lowering your single stock risk. I mean, if I just sort of take a side journey, if one looks at most global equity strategies in our market, the active ones, they tend to represent about 100 shares. Often less, actually, often more like half of that, 50 odd shares. Our global total world stock fund and ETF, that portfolio actually represents over 9,000 shares. So, the diversification is just on a different level entirely. And that translates not just to single stock risk, but to country risk, geographic risk, sector risk, and so on and so forth. So, passive core represents the lowering of risk of manager risk. So you just simply select the wrong manager who's right at the bottom of performance charts. You don't actually get the asset class return, improving diversification, and then that largest determinant of a client outcome, which is cost. So you are increasing the probability of the client actually achieving their end outcome by dropping down costs at the product level, and that's really important. So a passive core represents a really sensible allocation to an asset class. And then by all means, what we talk about is convictions to, or as allocations in the satellite portfolios to high conviction managers who are adding value that is different to what you are getting from the index. And by doing so, you get a typically smoother return profiles, you typically get better risk management in your portfolios, and you get a much more efficient cost allocation. So what I mean about this cost allocation, it's an interesting thing, and it's used extensively globally, but not as much in our local markets, where the idea is that, let me take a very simplistic example of a client who allocates to an offshore portfolio. Offshore equities is what they're looking for, and they invest in an active manager who, let's say, charges the average, so 1.2%. But that manager, because of business risk management and because of just sound portfolio construction, has constrained themselves in some shape or form to the benchmark. Maybe industry constraints, it may be stock constraints and active share constraints, and that constraint essentially means that a part of that portfolio is the index and a part is active, so where they are selecting active stock picks around that. Now, in the context of passive, of core satellite, what we want to say is rather have that active manager with all their skill set and so forth, unconstrained, making high conviction bets on stocks that they believe will add value to your portfolio or risk premium or whatever their process is. And when one looks to constrain a portfolio or an allocation, use a low-cost passive call. So rather than buying one thing for 1.2%, buy 60% in your passive call for like 36 basis points. And then by all means, pay 1.2% for that high conviction active outcome. And you end up at the same point, just at a much lower cost. And that cost compounds through time naturally. So really, we talk about putting passive in the call. And this can be in the context of, like if one looks at our ETF portfolio, a private client stockbroker may buy ETF as 80% of their clients' offshore exposure and then have 5 or 6 high conviction stock picks. A multi-manager might say, well, I'm going to put 40% into a passive call, and I've got my 2 or 3 active managers who I think are delivering value in particular areas that are clustered around it, that can be used in the context of smart beta and so forth. So really, it is a really sensible way of looking at of allocating money without having a binary view of active versus passive. It's looking at a portfolio construction really holistically. And of course, the idea of making a global equity allocation is as much looking at the context of South Africa in the global investment landscape as it is having a view on global ex-South Africa or South Africa. So, just to kind of, I guess, a reminder, something to hit home to say, South Africa is a very small part of our global equity market, and we still need to make, meaningful allocations to get back to a well-diversified portfolio. So there's really there's no need to be negative or have a view on South Africa. Often, most of the time, one just simply needs to diversify as far as possible. And of course, you're not just diversifying at a stock level, at a geographic level, also from a currency perspective, you are diversifying away from rand-based currency, which is important. And the kind of, that's really where we're coming from. Is it's a sensible allocation, of course, to have global equity. We want it to be well diversified. We want it to be low cost, and we want it to be super efficient and make sure that it delivers on that asset allocation goal. So we're going to have a jump into the kind of year in review on the FTSE Global All Cap Index, which is the index that we track. And we're going to hone in on just a few events and look at what was driving risk and return and so forth. So if we have a look at the year that's past 2021, it was a year that really was dominated by 3 main things. Of course, COVID, was something that was high on the agenda, high on newsreels and Twitter feeds and so forth. And of course, towards the beginning and middle of the year, a lot of positive news and optimism around vaccine rollouts, and then the Omicron variant later into sort of tempered some of that optimism. But the positive thing is that, the Omicron was a variant that was less severe. It seems like it's moving into an endemic as opposed to a pandemic. And that's obviously good for the opening of economies and specific industries which were hard hit by COVID. Inflation as a result, inflation as a result of COVID was a big talking point. Some of the supply chain slowdowns, which led to price increases and so forth. We've seen, really inflation spiking in the US, globally and in our local market. So inflation was a critical talking point and a key area of concern for investors worldwide. And one of our messages around that is it's often solved simply through asset allocation. So not through trying to predict inflation, where it will be in the next 6 months or 12 months. We know in the long term, inflation, for example, in the US sits at around 3%. We know that as an erosionary factor on portfolios, inflation is the number one risk. We need appropriate asset allocation to deal with inflation, and that typically sits with growth assets like equities and property and so forth. So inflation was really something people were talking about. And of course, globally, interest rates do remain low, although there's some potential, shifts in the interest rate environment, in the monetary policy environment globally, and how that will change in the next year. I suppose if we hone in on the equities, global equities, because that's really what we want to talk about, and I'm actually going to go onto the next slide, is we saw a year of divergent returns, and it was a divergence in returns between developed market equities and emerging market equities, where developed markets in rands delivered something like 32%, and emerging markets far less, 5.8%. Now, some of that had to do with emerging market sentiment and risk-off sentiment, and China was a big driver behind this because, of course, China sits as the major component of the emerging market basket, and there was a lot of noise around US-China regulations in terms of some dual listings and essentially regulatory cooperation between those two jurisdictions. And then, of course, the crackdown on some of the larger Chinese companies, Tencent, of course, we all know here locally, but also very large Chinese business like Alibaba. So emerging markets and developed markets extremely divergent, but remembering that emerging markets still only making up around 10-11% of your global basket. So on average, a great year in rands of about 28.8% for global equities, in dollars around 19%. So that additional 8% came from rand weakening, which was around 7.9% over the year. So a slightly weaker rand and a very strong global equity run last year, which was off the back of quite a volatile period in terms of the initial COVID period. What was really driving those returns? Well, essentially, two things drive return in a global mandate like this. One is just the sheer size of the sector or a share, and then, of course, the return, the absolute return. So information technology, or IT, was the largest contributor in return, delivering in dollars 27.34% of return. But of course, its return contribution is a function of its weight in the index, which on average was about 21%, which leads to the return contribution, delivering about a quarter of the total dollar-based return in that strategy. Financials and healthcare closely followed on there. Financials coming off kind of lows of the COVID crisis, one of the harder hit sectors. So in some respects, a re-rating of that sector relative to where it came from. And of course, healthcare, a lot of positive news around healthcare in the global context. The detractors from return, well, there were no absolute detractors or relative detractors on return. So every sector posted a positive return, which was quite something. But some of the less the lower contributions in returns came from materials, real estate, and utilities. As I say, some of these return contributions are not as a function of the absolute return, which was high, just a function of a low weight in the total index. At a share level, of course, in trend with the sector producing most returns, some very large returns posted by extremely large individual companies, Microsoft, Apple, and Google. Of course, Alphabet being a few there. And then again, to look at some of these trends, where were some of the largest detractors? Well, they came out of that emerging markets basket, so Alibaba, Tencent, and so forth. All of these companies detracting from returns coming out of that EM basket. So really, it all kind of hangs together. It was a story of big US tech driving a lot of returns in the market last year, China detracting from emerging markets, and really the rest of the global economy just kind of going for the ride and posting some very attractive returns. So really, for global equity investors, a great year altogether, all in all. So now for a few minutes, I'd just like to introduce our two new CoreShares Total World funds. They are funds that track this FTSE Global All Cap Index. It's the index I was talking about. It's an index that represents both developed and emerging markets, and it represents large, mid, and small cap shares. So a very thorough index representing over 9,000 shares. So a large component of of the total global equity opportunity set. something like 99% of that total opportunity set is captured in this index. The only thing it excludes is some countries that are not considered emerging, so that they tend to, the frontier markets, they tend not to have well-regulated exchanges and liquid currencies and so forth. They don't qualify, and what are called micro caps, so smaller than some of the small caps. So really, the investment case for the strategy is as I've mentioned, and at the expense of repeating myself too much, it's very simple exposure to global equities. It's an extremely diversified portfolio, and it captures all of the potential return drivers from large, small, and mid-cap shares, and from emerging and developed markets. And this is kind of one of our key critiques of a lot of the product that sits in our market, is that the economic exposure they capture, they tend to focus only on developed markets, with the idea that South Africa is an emerging market, and so one doesn't need to get exposure to emerging markets in our market. And we kind of dismiss that, as South Africa is actually quite a small component of the total emerging markets basket. It's heavily dominated by China, Brazil, and Russia. And these are exposures that are meaningfully different to our local market exposure, which is kind of even heightened by the fact that we've got this kind of split economy where we've got very large companies like Richemont and British American Tobacco and so forth, which aren't really representative of an emerging economy in many respects. So you're capturing the whole opportunity set at an economic exposure. I mean, this is something that's always been an agenda to talk about. It looks at the difference between contribution to GDP versus capital markets, and you can see there's a big difference between low capital markets representation, but a very high representation in terms of contribution to global economy. Emerging markets makes up about 40% of the global economy, only about 10% of capital markets. So one would expect that to contract, and as that contracts, you obviously want exposure to that emerging market basket. So in total, exposure to around 49 countries around the world, 90% in developed markets and 10% in emerging markets. You can see that this quite broadly represents the global basket. Of course, relative to just a pure developed market index, one would expect all of these weights to be higher, and say the US would be more like 66, 67%, and the other developed markets, Japan and UK, would also be higher. And where you rarely see emerging market exposure pulling through is in the, as I mentioned earlier, the Chinese exposure. So a big driver in terms of alternative exposures. If one actually adds all of the different Chinese jurisdictions, you get closer to 10% as an allocation to that part of the world. From this is closing December, you can see tech shares actually now hold a high weight in this total basket, 23%. On average, they were around 21% through the year. So that's the big allocation in this global equity strategy, and then followed by consumer discretionary, financials, etc. But what is absolutely mind blowing is the number of shares that represent these sectors. So the tech sector is not just represented by Apple, Microsoft, and Facebook, like it would be in many portfolios. It's represented by over 1,000 shares in total. I chatted about the full market coverage, and really it just gets you that extra exposure, the size premium as a driver of returns in the long term. And we're all familiar with these large companies that make up such a big percentage of total equity mandates. So yeah, in summary, when one's selecting an index, it's important that it's well diversified, that it's representative of the total asset class opportunity set, and of course that it's well priced and it's low cost. So we've priced our ETF at 29 odd basis points. Our unit trust is sitting at 42 odd basis points, and this is kind of talking about the fund and its cost relative to its passive peers. You can see it's kind of got more share exposure, more country exposure, and is extremely competitively priced at 0.29% TER. which is competitive on a global scale, not just in our local market. You would struggle to find a fund at this cost, with the exception of the fund that we actually feed into, which is the Vanguard Total World Stock ETF. That is globally the most cost-efficient means of accessing this strategy. As some of you will be familiar, we used to run an MSCI ACWI fund, which we remandated at the end of last year, which now tracks the FTSE Global All Cap Index. That fund's got about 1.4 billion in assets and track record and so forth, so has scaled. And then last year we launched the ETF, which has been well received, and it's got about 250 million that it's raised in the last 6 months or so. And that's really came in as our market cost leader in the global total space, which includes DM and EM and of course large, small caps. So thank you for your time, guys. I tried to keep it around 30 minutes. So I'm pleased I did so and I didn't bore you guys for too long. If you've got any questions, please shout. I'll call Michelle on to help me navigate some of the questions. And otherwise, thank you so much for your time. CPD points will be allocated for this. We're waiting to hear back exactly how many, but if you've participated and you've hung on till now, then thank you for joining. Michelle, I'm not sure if you've got any questions. Or...
Yes, we've got a few coming through. Thanks, Chris. That was great. Yeah, so just a reminder, please pop any questions in the Q&A tool. Now is your chance. We've got a few, so let's get started. So Chris, one question coming through. So, you're saying that it's really fantastic that there's this broad benchmark with, over 9,000 shares in it. How do you as CoreShares, run that efficiently and make sure that we don't get a huge TIC on this fund?
Oh, thanks. I mean, that's always been the challenge, right? It's how do we as a passive asset manager get this kind of exposure in our market and ensure that it's efficient and low cost? And the one way that we found the most efficient to do that is through feeder structures. So where we essentially start to leverage quite literally the largest global asset managers and their scale. In the instance of this fund, we feed into the Vanguard Total World Stock ETF, which is obviously an ETF that tracks the same index that our fund is tracking. And that fund is globally the cheapest global allocation that you can get exposure to, and by some margin, which enables us to bring that fund to the market at extremely competitive rates. I mean, the ETF, as I mentioned, 0.29%, and the retail fee on the unit trust fund at 0.42%. That's as a TER, so it includes the Vanguard fund and all of that. And really, the big advantage of that is we're not just feeding, and trying to leverage our own scale. We're currently managing around 12 billion, so not like a huge amount of assets, but we're now leveraging Vanguard scale. And Vanguard, in this particular ETF that we buy, has close on $30 billion. So call it 500 billion rands in the one fund. So you can imagine their scale and their ability to efficiently track that index is significantly greater than, quite frankly, any South African asset manager. Even our largest asset managers don't have the kind of scale and to match the efficiencies of Vanguard.
Thanks, Chris. So yeah, that's nice and clear. There's several questions coming through about platform availability of this fund. So as Chris mentioned, this Total World Fund is available as both an ETF and a unit trust. Obviously, the ETF is available to anybody who's got any sort of a stockbroking account. So it just trades like a share on the JSE. So any of your end clients who've got a share trading account would be able to find it. And the unit trust is on all the major platforms in South Africa. So I've got the full list here and I'll actually post it in the comment section. But yeah, so this CoreShares Total World Fund, it is available on AIMS, on Allan Gray, on Glacier, on 91, on Momentum, on Stanlib, on Old Mutual, on PPS, and on Wealthport. Some of them may not be on the public list, so you may just need to ask for access to the funds, but to the fund. on some of the platforms, but it is there. So I'll just send this. I'll see how I can put this full list into the chat. So you've got the list of all our fund availability. And while I am doing that, Chris, there is another question here about small caps. So obviously this seems to be quite unique that it offers access to global small caps, which is really nice and unique for South African investors. But doesn't that increase risk if you have small caps in a portfolio, or what are the benefits and the risk of having small caps in a benchmark like this? Sure.
So I mean, you're right. Small caps as a category comes with heightened risk. The risk is rewarded insofar as one would expect a higher return on small caps. So that's the risk premium, and that's the size premium that is obviously widely discussed to say that over long periods of time, small companies, because of the liquidity risk and the kind of risks associated with small caps, they need to be compensated for in terms of more return. So it's something that you want exposure to, but you need well diversified exposure. And so I would say that yes, it adds a risk, but a risk that is compensated for. And what is interesting is that you're not adding single stock risk. So you're adding a return driver as opposed to stock picking, let's say 3 or 4 small caps, which may well go out of business, and then of course you've got a permanent loss of capital in that scenario. So the exposure to small companies is an exposure that we would expect improved returns from actually, and when it's well diversified, we expect minimal single stock risk. So of the small caps, it's about 10% of the total portfolio. There's about 4,000 shares that make up those small cap exposures. It's like this huge tail that you're just getting exposure to that general driver of returns in our economy.
So I suppose you just need 1 or 2 of those to be the next Zoom going into the next COVID crisis, and you're winning.
Exactly.
Okay, that's great. So please pop any more questions that spring to mind.
Michelle, on the platform stuff, I think what's really important for us is that, when we talk about this investment strategy, we are agnostic between whether you access it in an ETF wrap or a unit trust wrap. To the point where we've now made we're trying to get our fees as close together so that they look identical. There are slightly different fee structures in the different product wraps. ETFs tend to be cheaper in terms of the total cost of running these portfolios. But it's really important because, we want to be able to, if you're an advisor and you happen to plug into, the Glacier platform, or if you're a private client stockbroker and you trade on the market, or however you access the fund, we want to make the strategy available to you as easily as possible. So, this platform stuff is really important so that advisors and DFMs can include them in their model portfolios across all of their strategies. And so if you've got any questions, please, about platform accessibility and stuff, it's a big part of our value proposition is to try our best to get them on platforms if they're not represented there. So please shout.
Okay, thank you. One question here about what is the total exposure to emerging Asia, which is where there seems to be a lot of growth at the moment.
Yeah, so emerging Asia is if you look at the EM basket, now emerging Asia is an interesting one because if you look at MSCI, they actually call South Korea emerging Asia. FTSE calls South Korea developed Asia. So that's why our emerging market exposure looks like it's around, in total, 10-11%. There's some rounding stuff there. Of that, around 80% is emerging Asia. So it is by far and away the largest exposure you're getting there. And most of that emerging Asia exposure is coming through China. And then if you include South Korea in emerging Asia, South Korea is a big constituent of that, about 2-3% of the total exposure. So if you include...
I seem to remember, I think Taiwan was also sort of up there. I seem to remember when China,
correct.
Last time I looked at China, South Korea, Taiwan, and then India. And then the smaller ones like Malaysia and Indonesia, and goes from there.
Exactly. You've got China, Hong Kong, Taiwan. Those are all basically Chinese exposures, but But emerging Asia, you've got South Korea, and then as you mentioned, some of the other exposures, India, Malaysia, etc. Those are your large drivers there.
Okay, fantastic. Well, that's the end of the questions that I've got in front of me now. So unless anybody has a last question to type in, now's your chance. Yeah, please get in touch with either Chris or myself if you think of any other questions after this. And as I said, the recording will be available afterwards, and we will circulate CPD certificates as soon as we hear back from the FPI. And yeah, we wish you all a good start to the year, and thanks again for joining us, and thank you, Chris, for the
Thanks,
presentation.
Michelle, and thanks to everyone for joining us today.
Thanks. Have a good one. Take care. Bye.